Well, the uncertainty is over. Whether you were happy or disappointed about the results of the election, any and all markets are very happy to remove that question mark of future policy. It allows the market to start to get its footing, and we're definitely going to be talking about some possible things coming up down the pike. In this video, we're going to go over the single-family and condo markets in the state of Massachusetts. We're also going to do a quick interest rate update, and we're going to talk about some relevant current events. Hey, it's Jeff Chubb, a recovering investment banker, turned real estate agent, and real estate investor that has sold more than 1,000 houses. If you have any questions in regards to real estate, then no, I'm here to help. A client of ours just closed using the purchase power plan. He ended up spending $3,500 on our real estate services when buying a house, and this is compared to 2.5% of the $500,000 or $12,500 that he would have paid using the traditional buyer agency model. He saved $9,000. Want to save thousands, possibly tens of thousands on your own purchase? Then reach out and let's talk about the purchase power plan. But let's jump into the single family market stats. The fall pullback, it continues. Yes, sellers, it's true that inventory is going down. But if we were to see a similar chart, if we could just somehow get a data set for buyer demand, I'd actually say the demand chart would be an even more aggressive of a pullback for buyer demand. We now have 5,278 single-family homes on the market. This is 8.5% fewer homes on the market than just 28 days ago. With inventory levels going down, the market's beginning to tighten up a bit, but buyer demand continues to be weak. As I've said before, I do believe this could be a rough 4 or 5 months ahead as interest rates, let's just say they're not cooperating. For the last 2 weeks, the fall pullback seems to be going at about the rate that we saw in 2023. We now have 790 more houses on the market when compared to the same week last year, 328 more houses on the market when compared to 2022. We listed 750 single-family homes this week, which is compared to 703 this week last year. This means that there were 47 units, or 6.7% higher than the levels we saw in 2023. And that 4-week rolling average, that's 883 units. New listings and under agreements, they're up. This week, we put 847 single-family homes under agreement. This is 49 units, or 6.1% more than the same week last year. We put 798 houses under agreement. That 4-week rolling average, that's 909 units. So when compared to last year's market, new listings, they're up by 6.7%. Longer agreements, they're up 6.1%. So pretty balanced there. This pending to new listing ratio shot up. The ratio of 113.8% is compared to the 103.4% that we saw this week last year. What this means is about 114% of all the properties that came on the market 2 weeks ago went under agreement last week. It's kind of interesting that this ratio shot up this week as well as last year. Maybe this is just a little annual surge before the Thanksgiving holiday. I'm not quite sure, but that's the only thing that I could think of. There were 815 single-family homes that closed last week for an average sales price of $821,000 and a median sales price of $645,000. Sales levels compared to the same week last year were down by 12 units or 1.5%, as there were 827 single-family homes that sold this week last year for an average sales price of $746,000. Months of inventory, this is how we determine what type of market we're in. 0 to 5 months, that's considered a seller's market. But the closer you get to 0, the stronger, more aggressive of a seller's market that it is. Now, this week, months of inventory came in at 1.75 months. 1.75 months this week is compared to 1.61 months this week last year. And the gap between this year and last actually fell to 0.14 months. This market continues to converge and become more and more similar to the 2023 market, which was not a great market from a sales perspective. I feel like no one believes me, but if you are a buyer, and this is a phenomenal market to be buying a house in, there are deals to be had out there. You just need to know where to look for. Real quick, it's my shameless plug. I just want to mention that if you are thinking about buying or selling a home, then it would be a true pleasure to help you. Now, onto the condo market. We now have 2,939 condos on the market as of Monday. This means that there's 11.3% less inventory on the market today than the inventory levels of just 28 days ago. We now have 407 more units on the market today than today last year. We have 358 more homes compared to the inventory levels of 2022 and 502 more units than in 2021. There are 332 condos that came on the market last week with that 4-week rolling average of 405 units. The 332 units listed as 45 units, or 15.7% more than the 287 condos that came on the market this same week back in 2023. This week, we put 352 units under agreement. Now, this 352 condo sales is 31 units, or 9.7% more than 321 condos that we put under agreement this week last year. That 4-week rolling average, that's 392 units. So 15.7% more listings came in the market compared to this week last year, while sellers selling 9.7% more condos. This week's pending new listing ratio is 108.3%. This is compared to the 92% that we saw this time last year. There were 292 condos that sold this week for an average sales price of $708,000 and a median sales price of $538,000. The same week last year, there were 317 condos that sold for an average sales price of $645,000. So sales levels were down by 7.9%. Months of inventory fell to 2.46 months this week compared to 2.51 months that we recorded last week. This is compared to the 2.22 months of inventory levels we recorded this week last year. Now, the year-over-year inventory level spread increased to 0.24 months. And just if you made a huge favor, hit that like button right down there. Believe it or not, it just makes a huge difference for me, as well as the channel just plays with that YouTube algorithm. While subscribing, that one doesn't hurt either. So if you haven't subscribed and you're enjoying the content, I appreciate you considering subscribing. Time to talk about interest rates, though, because interest rates continue to go up and up. You notice in the last week that interest rates are up by 0.16%, and that is the time after the Fed cut by 25 basis points. So interest rates went up by 1% last time the Fed cut the federal funds rate by half a point, and now we're up by 0.16% since the Fed cut an additional 25 basis points. So should we just go ahead and assume that mortgage rates are going to go up another half point from the most recent rate cut from the Fed? The Fed chairman, who I've not made it a secret that I can't stand and think is an idiot, came out and said there is a good chance that they're going to be, wait for it, increasing the federal fund rate in 2025. I had asked 3 weeks ago how the Fed could cut interest rates. After the last time they cut it, it actually created a surge in the 10-year Treasury pricing, which led to higher mortgage rates. And we can all acknowledge that the increase in the 10-year means that the markets believe that in the long term, that interest rates will go up. So we need to ask ourselves, why would interest rates go up? It's because the market believes that the inflationary pressures will come back. Now, let's add in Powell's comments that they will most likely have to start increasing interest rates in 2025. So why the heck did they cut? What sense does it make to cut to only have to hike again? Especially when they say there's no risk of a recession, which I don't necessarily agree with. What does this mean for rates in the near future? Okay, here are my thoughts. If you're waiting for interest rates to come down in order to buy, then stop holding your breath. I just don't want to see you do any personal harm to yourself. They may go down, but we most likely won't see any significant moves. Let's all be honest with one another. That a new administration can't just wave a magic wand and fix inflation issues that face those normal, everyday Americans, and we just try to keep a roof over our heads and put food on our kids' plates. It seems like this new administration is focused on a plan that actually grows the economy while trying to phase in monetary responsibility and closing the federal government's checkbook. My opinion is, while I do believe they can achieve growth, I have the zero faith that any legislature body is able to stop all the irresponsible spending by our Washington elite. In other words, if rates are going to go down, then it is going to take some time for all of this to sort itself out and make its way through this enormous economy. Because it doesn't look like the Fed is going to offer any help, and based on their words, are going to become much more hawkish in the new administration. And that's great news for the folks who want lower inflation, but not so great news for the folks who want dirt cheap interest rates. And by the way, in my opinion, that is a good thing. Lower inflation is much more important than artificially low interest rates. After all, Milton Friedman says it best. Inflation is taxation without legislation. Want to talk about your own personal real estate needs? Again, it's Jeff Show. Whether you're looking to buy or sell a house in the next 9 or 90 days, then I would love to chat with you and just find out more about your real estate goals. And if you know of anyone that's saying about buying or selling a house, then I truly appreciate you passing along my contact information. You can visit YouTubeRealEstateAgent.com or find all my contact information in the description below right down there. Until next time.